Okay, so now we're in the home stretch, and we're going to do some of the slightly more sophisticated dividend growth model stuff. So, Internet Software Limited (ISL) has announced that it plans to have an equity issue. In other words, it's going to issue shares, and has told the Securities Exchange of its planned dividend policy. Okay, you're trying to encourage people to buy shares, so they want to know what to expect. They want to know what dividends they're going to be getting. So, they've just paid a dividend of $10 per share, and in the announcement indicated that they will be able to increase dividends for the next few years as they grow rapidly before settling down to a more constant growth in profits and dividends. So the dividend for next year will be $12. The year after that, it's going to be $14. Then it's going to be $15. And then dividends after that will grow at a constant rate of 7%. Okay, so you think they're a risky company and you want a 25% rate of return to compensate for that risk. So what price would you be willing to pay? And if they were trading after the announcement for $65, would you buy them? Why or why not? And really, that's answering the same question. If you work out what you're prepared to pay and they're trading at more, then you're not going to buy them because they don't meet your required rate of return. Okay, so do you want to have a think about it? All right, I assume you've paused and had a thought about it, had a think about it. So let's do a little timeline first, just to work out what's going on, and then we'll move forward. Okay, so the dividend's just been paid for the first period, so there's nothing happening at period 0. 1 year from now, we're expecting a $12 dividend. A year after, a $14 dividend. Year 3, a $15 dividend, and from then onwards, 7% growth. So what we're going to do is two things. We're going to calculate the present value of the first dividend, the present value of the second dividend. So we're going to bring those back to period 0, right? That's what present value is doing. And then, starting at the end of period 3, there is a stream of dividends. It starts at $15 and it's going to grow 7% constantly. So the first payment is there at date 3. So if we're looking forward at that from the beginning of period 3, in other words, date 2, we can basically price an annuity, work out the value as at date 2 of these payments that are going to happen 1 year away, 2 years away, 3 years away, etc. So first thing, price the annuity. So basically look at these payments that are happening in period 3, period 4, etc. So the first payment is 15, a year away from now. We're expecting a growth rate of 7%, and our required rate of return, our discount rate is 25%. So that gives us $83.33. So what that is the price at date 2 of all the remaining dividends that are going to happen from period 3 onwards. So 1 period away from date 2. Okay, now that's calculated the present value of those things in future periods, but from a date 2 perspective. So we need to bring that also back to date 0 so we can add them all up. Okay, so first thing, work out that dividend growth model as in period $2, date $2, and then bring those date $2 back to date 0 by discounting by the discount rate by 2 more periods. Bring the date 2 dividend back to date 0 by discounting 25% 2 periods, and bring the year 1 dividend, $12, back by discounting by 1 period. Okay, add them up, and we get $71.89. So basically, using those assumptions for dividend change in the first few years and then constant growth later on, you would value this share at $71.89. So given that you think it's worth $71.89, those assumed cash flows will give you a 25% rate of return. If the shares are currently trading at $65, hey, that's a good buy. Because if you pay them for less, you actually be getting a rate of return in excess of 25%. So yeah, this is awesome. Really, the shares are underpriced. You should be buying them. All right, now let's move to a standard two-stage model. Okay, so what we're going to have is we're going to have a little bit of growth in the first few years, and then we're going to have less growth later on. So Apple Isle, hey, I'm a Tasmanian, Tasmania used to be called the Apple Isle. Apple Isle is trying to work out its listing price as it's going to list on the ASX. Apple believes it will be able to pay a dividend of 25 cents per share in the first year. The dividend is expected to grow by 20% per annum for the next 4 years. So years 2, 3, 4, and 5, and then go to a constant growth of 4% thereafter. Okay, so year 6 dividend is going to be year 5's dividends plus 4%. Year 7, same change from year 6. So if Apple believes that investors require a 14% rate of return based on how they assess its risk, what would be a fair price to list at? Okay, standard two-stage growth model. So you want to work out a little annuity for the first few years, and then a slower annuity with growth, and then a slower annuity in the later years, and then bring that back to date 0 as well. Give that a few moments. Okay, now unfortunately we don't have any fancy little model for an annuity that's going to stop with growth. We've got that really cool formula for a perpetual annuity with growth, but not for a short-term annuity. So let's do the upfront bit just by hand. Okay, the year 1 dividend is 25 cents. The year 2 dividend is going to be 20% bigger, so 30 cents. The year 3 dividend 20% bigger than that, so 36 cents, etc., etc. That takes us up to year 5. Okay. Okay, so now let's put all that on a timeline. We've got the dividends here. These are the ones that had the 20% growth. Okay, and then after that we've got 4% growth. So we've got first dividend, 52 cents. All the following ones are going to be 4% greater than the previous one. So we're going to be calculating cash flows of a perpetuity with growth from year 5 onwards. Since when we calculate these perpetuities, we always assume that the first payment is a year away, and the first payment is in year 5, or date 5, we're basically going to be calculating the present value of this perpetuity as at date 4, so in date $4. So once we've calculated the present value of that perpetuity, we've got to bring it back from date 4 back to date 0. Okay, so the present value of the perpetuity, first dividend is 52 cents, rate of return that you want is 14%, the growth is 4%, so that gives you $5.20 in year $4. Okay, so now we've got all the cash flows that we need to bring back to year 1. To year 0. We've got these dividends, which we're going to take present values of individually. And also at year 4, we've got $5.20, which is the value of all the remaining dividends under constant growth of 4%. Okay, so here's a calculation where present value of the first dividend, second dividend, third dividend, fourth dividend. And remember, the dividends from year 5 onwards, we've already calculated using present value of a perpetuity in year $4, date $4. So we calculated that to be $5.20. So we've got to bring it back from year 4 to year 0. So there it is. We added up $4.02. So what would you list the shares at? $4.02, almost $4.03 is a reasonable price. Okay, on to the last one. Okay, so for this one, we've come back to bonds. So this is a fairly real-world situation where you issue some bonds in order to get some financing for something, and then you release funds through doing something else. You sell some assets, or you scale down your business and you want to pay off some debt. Now, you could pay off some debt where you have no conditions, or sometimes in anticipation of this, when you issue some bonds, you will actually say, look, we're allowed to buy back the bonds early. Now, that might say that you buy them back at whatever the market price is at that date. So, these people don't care who they're selling to, so long as they're getting a fair price. Alternatively, you might actually specify an attractive yield at which the repurchase is to be made. Okay, now remember, the lower the rate of return, the higher the price. So if the contract specifies a lower yield, that means these people are going to get back a higher price. So let's talk our way through the problem. On January 1st, 2000, Daytona Motor Corporation issued 20-year bonds with a face value of $200 million to finance its engine building plant in Victoria. Due to the sale of this plant to the Ford Motor Company for $300 million, DMC wants to use part of the proceeds of the sale to buy back all of the issued bonds. Okay, the bonds were issued at a coupon rate of 10% per annum, and interest paid is half yearly. All right, 20-year bonds, half yearly, so there's 40 periods, 10% per annum coupon rate, that's 5% per period coupon rate. DMC had written into its bond issue that it could compulsorily acquire all the bonds. This means that the yield DMC will have to use to buy the bonds is 9%. I presume that's from the contract. So what is the amount that DMC will need to pay on the 1st of January 2011 to buy back all the bonds? So the first thing we've really got to do is work out how many years have elapsed and how many years are remaining. Now, they were 20-year bonds, right? So let's take a little pause. Feel free to press pause and give it a bash. So you either pressed pause and gave it a bash, or you decided to go straight to the answer. Let's have a look at it. Okay, so they were issued on the 1st of January 2000, and now it's the 1st of January 2011. So 11 years have elapsed. That means 9 years remain to maturity. And remember, 6-month periods, so that's 18 periods remain. The coupon rate is 10% per annum, but coupon's paid twice a year. So 5% of 200 million is 10 million. So we've got a face value of 200 million, a coupon of 10 million. The yield to maturity is 9%, but that's per annum. Half yearly is 4.5%. So we are working out the present value of an annuity that goes for 18 periods at 4.5%. Okay. Look, I probably should have written 0.045 here. Remember, 4.5% is just a fancy way of writing 0.045. So this top term is basically taking the coupon payment, and here's the formula for an annuity for 18 periods at a rate of 4.5%. So that gives you the present value of the coupon part. And then the face value, well, that's 200 mil. It's 18 periods away, and we're discounting at a rate of 4.5%. Calculate those, sum them up, and you get the price. So if you want to buy back your bonds at that rate, that's how much you would have to pay.